Good morning. Welcome back to the Brew. Today on the Lex Factor, part 2 with Mr. Eric Hale of TraderOasis. You remember from the first one, we talked about the 6 steps, setting up a trade. Now we're going to see an example. So let's get to Eric and go through how he envisions his trading. Let's do it after the bell. Yeah, baby.
Yeah, baby.
Yeah, baby. Do you know how much money we had to pay to have that little blurb in there?
It was
Everything's
awesome.
copyrighted, right? Or something like that. I don't know.
It always gets me excited, get pumped up. And I'm looking there, see if there's anybody in there that I know.
That's right. That's right. Very cool. How are you, buddy?
I'm doing great. How about
Good.
you?
Good. I'm doing great. So just to refresh, this is part 2 of the Eric Hale extravaganza, TraderOasis. Part 1, we went through your 6 steps. What I'm a big fan of, by the way. Huge fan. I love steps in retail trading. You have to be disciplined. I can't say it enough, and I know you can't say it enough. So I think we're going to review those real quick, and then let's go into an example, if you have one, and show how this process works in real life. Does that sound good?
Yeah, that sounds fantastic. So TraderOasis is where people come to trade. We've got a fantastic trading platform and all kinds of resources to help people find trades and place trades. And we came out of Options Animal. That's the OA, and Oasis is Options Animal.
Let me ask you a question. How many times do you have to come up with a word with the OA in it? Is it always, it was easy? You just did a Dolly search?
Did I do it? No, there was no AI when we came up with that name. In fact,
I think that's pretty impressive.
We wanted to go with just Oasis, and we were going to do something with the logos, but Oasis was taken. There's some European crypto company that does Oasis.
I love it.
Yeah, so TraderOasis is what we settled with, and so we talk about Options Analysts, OA. It's not a song. And then we, just so is the OA platform and Oasis, it became Oasis, and that's where.
Perfect. That's great. I love the logo too. Very cool.
The important thing that we've learned, we've been around. I've been teaching there for 20 years, teaching people how to trade stocks and options, and what we've learned is that emotions are a big thing. So they affect us, and seldom. I mean, when can you think of making an emotional decision that was a good decision? There's places for emotions, highs and lows, but trying to not let the emotions of fear and greed get in the way. And we think of following a process is the way to do that. We talked about that in the last episode that we did here, which was a lot of fun, by the way. I wish we could have gone longer. So now we're picking up where we were. And so we're going to go through just a quick review of what are the 6 steps. So the first step is to determine direction. And so if you ask, why do stock prices move? There's really 3 different reasons why a stock moves. It's either something changed fundamentally to like the long-term value of the company. A lot of times technicals matter. So when we look at technicals, maybe a support level or a trend line, or maybe a crossing of a specific moving average or something like that. And then there's also sentiment, which is emotion. Now, these are talking about stock direction, but as you and I talked about last time, we trade options. We're trading more than just stock price. Right. And stock traders focus on stock price. Option traders focus on stock price, but as well as the other things that affect the stock price or affect the option price. And that is time and implied volatility. Those are the 3 big ones: stock price, time, and implied volatility. So we want to make a forecast on all 3 of those. Right. And we develop a sentiment in the terms of the Greeks. We would think about where we want our delta, where we want our theta, and where we want our vega to be. Now, theta, there are trades that are theta negative. You buy a long call, you buy a long put. It's a theta negative trade. It's going to lose money with time. They're a wasting asset. They're insurance. If you don't use insurance, you lose money. But that doesn't mean you can't buy them. So, but the truth is, if you have one of those Greeks working against you, if theta is negative, that means you need to be making it from the stock direction or the implied volatility. So your confidence in those forecasts have to be better.
Right.
So the second step is we then look at trade possibilities that match those sentiments. So we're bullish, we know time's going to move forward, and we think implied volatility is going to go up or down or whatever the situation is. And we would go through looking at trades that match that sentiment. The third step is when we actually, so number 3, the third step is to select and structure the strategy. This is where we go look at option pricing, and we look at the risk, the reward, how much profit we can make, how much our risk is, which either could be the capital you put in the trade, or it could be buying power that's taken away. For example, a credit spread, you're not spending money, you're getting paid, but there's risk that's coming away. So we ask ourselves, are we getting a fair return on the buying power that we have here? Does this fit in our portfolio? Sometimes you're looking for a stock and maybe you think there's support at like $65 and there's no strike at 65. Maybe there's a 60 and a 70 or something. So sometimes we can't find the trade that works. We might have to go back and pick a different strategy.
Let me ask a question real quick.
Yes.
Sorry.
Yeah, of course.
Select structure. Does implied volatility come in on any of these 4 yet? Well, I guess you're going to talk about 4 in a second. But on the first 3, have we looked at implied volatility yet, or not really?
Yeah, we look at it here. So we look at the forecast. Where is implied volatility now?
Yep.
Where do we expect implied volatility to go up? Is it going to go up? Is it going to go down? Is it going to go sideways?
Perfect.
Or maybe we don't know. Or sometimes we are sure it's going to move, but we want to maybe neutralize it. So we need to think about the context of what's going to happen with implied volatility. Is it going to change in this trade, and will it benefit me or hurt me?
Okay, perfect.
So, and as you know, implied volatility we could probably spend a week talking about implied volatility. So we're not going to go too deep here. Maybe we'll cover that in other episodes.
Okay. Got it.
So then we structure a strategy. We think, hey, I think the risk rewards, the probabilities all kind of look good here. Then we go to what is.
I like this part, and you make the emphasis here on the exit. We haven't put the trade on. You're already defining exits. I love it. Talk about this.
This is, if there's one thing that I could tell traders to do to become more successful, and that is to be clear on your goals. If you want to get anything done in life, you have to know what you want to do. So being clear on when am I going to close this trade? And I find too many people who place trades that make a decent profit and then say, oh yeah, let it roll. Here we believe in being clear on what is our primary exit, which usually would be a percent profit. So maybe I'm going to make 20% ROI or whatever you decide your return is. But it could also be based on, I'm going to take whatever profit I have before the next Fed meeting, or I'm going to take profit that I have, whatever profit happens after the earnings event, or I'm trading Coke and I'm going to do it when Pepsi does XYZ. So being clear on what are those criteria where you say, I was successful, and then you close your trade. This is one of the things that stock traders and option traders are different. I'll take my portfolio to zero. I'll close every single position that I have. I don't need to keep stock positions. If you're a long-term stockholder and you're building, you trade a little bit differently. But option traders, we can go to cash, and that gives us opportunity to go in and out of markets. So it's one thing that's a little bit different than stock.
Do you, in point number 4, when you determine these exit points, does the time to expiration ever matter? Meaning we have 0 DTE, let's say on the short end, and we have, 60 days to go to expiration. So what my point of my question is, on a 60-day expiration kind of trade, do you look for a smaller percentage of profit, of max profit to get out of versus the 0 DTE, or irrelevant? You just have your measure and you go with it irrespective of the time.
So that's interesting you bring that up, because one of the factors that we look at is not just return on risk, but an annualized return on risk.
Okay.
So the example I give to people, why does annualized return on risk matter? Well, first of all, when you're talking about a return on risk or annualized return on risk, we're talking about percentages. You can't spend a percentage. You can only spend dollars. So it has to make sense. But if, Lex, I've got 2 trades that require the same capital and they have roughly the same probability. I've got one that makes 5%. I've got one that makes 20%. Which trade do you want?
You know which one I want. I want the big boy.
Well, the right answer. This is a trick question, buddy. Because
I'm sure it is. That's why you asked it to me.
Right. The question is what's the duration of the trade?
Yeah.
So if you can make 20% in a year
Yep.
versus 5% in a month.
I like the 5% of the month a lot.
Yes, you do, because that's 60% in a year.
Yes.
So just without compounding, 60% annualized return, a 5% trade is better than a 20% trade. You're going to be out of the trade. Now, if you're only making pennies, that's maybe it's not worth it. But so there has to be some sort of a threshold that makes sense.
Sure.
But when you do need to take the duration of the trade into account. Now, some of these short-term trades have crazy high annualized returns. Like you could look at a 0 DTE trade that has like 1,200% annualized return on risk. So this is when I tell people that it's you can't really spend a percentage. Maybe I'm making a quarter on a trade that has 75 cents of risk, and in one day it's got some crazy 1,000% or 2,000% annualized return on risk. It's not realistic. I mean, maybe a quarter is worth it, but and would you do that sort of trade every single day? Maybe not. The risk is not there. So you have to take it with a grain of salt and put everything into perspective.
Got it.
But defining the goals, which looking at what that return is, and I'll actually have a little spreadsheet that I've already pulled up to share an example here on that I do show you how you calculate the annualized return on risk.
Okay, cool.
Now, what I think, so determining your exits, I mean, anybody who's trying to get anything done, you got to know what you want to do, right? It just sounds so obvious. Why would you even say it? Too many traders place trades thinking, "Oh, we'll see what happens and let it ride or whatever." I've seen people, place a long call, you make money right away, like, yeah, let it ride, and then they end up losing money. So be clear on what your exits are, call it a win, move on. But I think the most important thing that you can do is to determine your secondary exits, and this is what happens when your primary exit doesn't happen. Now, there's usually only one thing that can go right in your trade, but there are multiple things that can go wrong. You could have a volatility crush or a volatility change that you weren't planning. I mean, time doesn't move backwards. We know time moves forward. But you could have a stock, you could have the bottom drop out of a stock. You could see a 20% move overnight. And those things happen from time to time. Sure. So thinking through secondary exits, what do I do if this trade doesn't work for me? And what this allows us to do is you can get into a real state of Zen here. And this is why I call this the tranquil trader, because you can be agnostic on the direction of the stock. Really don't care which way it goes. As long as you can be objective, because you can adjust your trade to make money in whatever that new direction is.
Sure.
So when we look at secondary exits, they often require, they're going to require three things: more capital, more time, and more risk. So capital and risk are not necessarily the same. So you could buy a stock and maybe have a long put, so your risk is less than the capital in the trade. But those are three resources that you have limited. You only have so much time, you only have so much capital, you only have so much risk exposure that you can take. So you think about it before you place the trade. What am I going to do for this trade? How much capital am I going to set aside? If, for example, somebody will do like a short put strategy where buying the stock is what you're going to do, should you set aside that capital? I would debate whether or not a trader needs to set it aside, but it has to be available. Sure. Maybe it's in another account. Maybe it's in another trade. Maybe it's something you're going to transfer in. I mean, who knows where that capital is? Or maybe it's just sitting there in cash.
Right.
And you should be thinking about that capital. I mean, it's not a valid exit if you have no way of buying the stock. And if your plan was, well, I'm going to buy the stock, but I don't have the money to buy it, then maybe you should go look at it. Well, either define a different exit, which might be, okay, when it loses money, I'm just going to close trade when it's down 10% or 50 or whatever the metric is.
Right.
And that's fine. You just write it down and be clear. And then you mentioned earlier, this stuff all gets written down.
Yeah, I like that. The secondary exit is that, I just want to make sure it's a clear distinction. Is that the secondary adjustment, potentially the secondary stop loss exit? Is the secondary exit the bad news part of the equation? This is the bad news, right? The good news primary exit is a profit. The bad news is secondary. I just want to make sure I'm clear on that.
Yeah, but the bad news doesn't have to be bad news.
Forever. We can change it to good news.
It
might take a new shake and bake, but we can make it happen.
It could be good news. Yeah. So there's
right.
different ways to think about this. I'll show an example of a couple different ways to approach an equity that I'm looking at right now.
Got it.
So then the next step is placing the trade. So we place the trade, and then we're going to monitor and adjust, and we keep an eye on all of these things. We watch the earnings events. We look for changes in sentiment, fundamental, technical, and those will dictate subsequent adjustments.
Yeah. So let's not gloss over place the trade. So and the reason I say that is I have a little theory in my head. You place the trade at a price. I'm assuming you don't just hit the market button. Is that right?
Oh, yeah. Always limit orders.
So the price is sort of important because you've done your analysis around this price. I'm assuming, right? Your probability of profit is all based on this price as well. So my thing about this is that, don't get FOMO, fear of missing out. If you can miss the trade at your price. Now you've got to make a determination. Does it make sense to go down a nickel or down a dime, or pay up a nickel or pay up a dime, whatever? Could be yes or no. I'm not sure yet, but you can't chase it infinitely because you're going to take all your edge eventually, right? So I'm a big proponent of that, the FOMO proponent. But I want to make sure we're on the same page there. Maybe we're not, which is okay.
No, we are. Yeah, and you got to be careful with chasing a price. I always try to get something better. If I can try and get the mid price, but you got to be careful. I'm sure you've done it before. You place a trade at the mid, and then
I've done it.
The ask get wider, and it moves, and then you're like, wow, if I'd have just placed it at the natural, then I would have been able to get filled, and now it's moved, and you're chasing trades. Right. So we didn't go into the importance of liquidity. There's a story I tell people about Decker Outdoors where I gave up 30% profit. Literally 30% of my profit was just to the bid ask spread. This is maybe 10, 15 years ago when everybody was wearing UGG boots. My wife told me we're going to spend $1,500 in UGGs. I'm like, what are UGGs? It just sounds terrible. Why would anybody want to wear something called UGGs? And, my daughters had to have those, calf high boots.
Sure.
And then everybody got UGG slippers. And I said, who is this company? I got to buy stock in them. It was Decker Outdoors. And they were not very well traded, and their liquidity was terrible.
Yeah.
I ended up losing money on I should have, if I could have gotten filled at the mid price, I would have made 30% on the trade, but I broke even because I gave it up to the bid ask spread. So this is an important lesson for retail traders. The goal here is making money, not trading, your favorite equity.
Right.
So be willing to walk away from stocks that have poor liquidity.
Yeah, I agree with that. Couldn't agree more. I'm a huge proponent of that. You can even put that into a number you can understand too, but we'll get to that another time. Okay, so now you monitor and adjust the trade if needed, right?
Right.
And we'll probably see some of that in the example. Is that right?
Sure.
Let's go to an example. What do you say?
Let's do it. So here's an equity, Lex, that I've been looking at. This is sort of apropos right now. This is Pinterest. Today is October 1st. I'm not sure when we're streaming this. But this equity, a lot of social media company, a lot of people know that. Anybody doing home design, I'm sure your wife has come look at my Pinterest pages.
What's Pinterest? Is it just PIN?
Pins, PINS. And that's what you do is you have pins.
Got it.
This is, if you want to, curtains or home design or all kinds of, they really found a pretty good niche. And apropos because today, Goldman Sachs added them to their conviction buy list. So Goldman Sachs has 25 companies that are on this list, and companies come and go. But as of today, this company was just recently added. There's some other positive news that's out there. From a technical standpoint, it looks like we've been hitting resistance somewhere here around 33. It did break higher, I think, on the news today. The stock went a little bit higher, but it's pulling back a little bit. So maybe we've got some resistance here. I'm not a very big technical trader, to be honest with you. I think it's a little bit like horoscopes. You can you can tell anybody. You can make any story you want be true.
That's probably true. There's a chart on every ship that's sunk at the bottom of the ocean. Go figure.
I love that. I'm going to steal it.
Oh man. Anyway,
I'm going to steal that. So, from a technical standpoint, we got a MACD crossover, 5 and 20 day crossover. We're near the top of the Bollinger Band. These can be considered bullish things. We've established a level of support here. So from a technical standpoint, this looks bullish. Down here on the bottom line, we have this blue line and the yellow line. The blue line is the implied volatility for 30 days. The yellow line is the historical volatility. That's the actual volatility that happened. So you can see the yellow line jumping up when the stock gaps. And so earnings, what happens is the stock, kind of goes sideways. We see option pricing going up. That's what implied volatility means. Implied volatility is going up. And then we see a gap and the historical volatility goes up as well. So each one of these periods. And if I asked you, where do you think this blue line is going to be in this period out here, you should tell me that it's going to be somewhere up around 64.
Yeah.
And so right now, what's that?
I agree. Yep. I see it.
Yeah. So the implied volatility is going to run up here. Implied volatility is going to increase, but this is a little bit of a tricky situation because this is the 30-day implied volatility.
Yep.
So we have to keep in mind that any options that are after 30 days or longer, those will be affected by an increased implied volatility. This is Pinterest. They have not announced their earnings. It's going to be somewhere around November 1st, which is exactly 30 days from today. So we don't quite know which expiration is going to be the earnings event. So we could look at a trade that is either before or after earnings. If we want to try and take advantage of this increase in implied volatility, we probably want to be buying or looking at the options after. For simplicity's sake, I'm just going to make the assumption that we won't see implied volatility increase for the expirations that are before earnings. Now they may go up or down, but they won't go up because of earnings. So I've already limited myself down to the expiration series that's before November 1st. And if we look here, you can see the implied volatilities for the months. We've got 47, 48, 50. So November 1st, earnings might be on November 1st, but they're definitely going to be before this November 8th. So I'm going to avoid those two expirations. I'm going to try and do this in the next week or two, or next 2 or 3 weeks. So look at this October.
Yep.
This is the monthly expiration. This is the quarterly. And when I look at the chart, this is a little bit interesting sort of thinking here. We got a bullish trend. Goldman Sachs recently added it, as I mentioned, to its conviction buy list. Morningstar, which does a great job on fundamentals, puts a fair value of 43 on this stock, which is not unreasonable. The stock's been trading at 43. So Morningstar's got a fundamental rating that is positive. We're seeing some positive news that's happening. Today, the stock's struggling a little bit to get up, break above. My sentiment on this would be bullish. I think the market is relatively calm looking at the implied volatility. Other than the earnings event, there's no other fear catalysts that are out here. And so fundamentally, technically bullish, sentimental, I would say no fear. And we're really not going to try and do a Vega positive or negative trade on this. We're trying to keep it simple. So the Vega doesn't matter so much to me.
Okay. Is that because it's just not extreme enough one way or the other?
Oh, I mean, it's 48 right now. It's going to get up to 67.
That seems extreme.
But that's going to affect this November 8th or November 1st. If I wanted to try and take advantage of volatility, and a very interesting trade would be buying this expiration series and selling this expiration series. Because let's think about my notion is that this 51 implied volatility is going to go to 65, maybe 70. So this is going to go up. This expiration will not go up because of earnings, because earnings is going to happen after this option expires. So if you wanted to try and get Vega in the trade, we could look at trying to buy an option out here and then maybe sell an option here. And we could get a diagonal trade, which is going to be Vega positive.
I like it.
Yeah. So this has got some moving parts on it. Unfortunately, if we look at what happens with this trade, if the stock does gap way high, I could potentially lose money on the trade. My risk is limited to the downside. And I was going to keep it simple for this first example. I would look at something like this, maybe play with the strikes a little bit to see if I can I like this trade a little bit better because if the stock gaps higher, I don't lose money. So this is a diagonal trade and the Vega is most definitely positive. It's a theta positive trade. It's a delta positive trade. So I've got all of my three things working for me in this trade. So this trade could work. We might even consider running this. because there's another benefit here,
Mhm.
and that is if we get to the October 25th, and let's say the stock just kind of hangs around, maybe it drops a little bit, and I break even, well, I will have captured 565 from this 118 put. If it expires out of the money, or I'm able to close it maybe close to expiration, that's the paper trading ding thing.
We're dinging.
Yeah, we're dinging over here someplace.
Okay.
Um,
So I like
anyways.
it. So this is a diagonal, is what we're throwing up here, right?
This is a diagonal.
Okay.
I was going to keep it simpler than this, although I think it's interesting.
Yeah.
I looked at some other trades. I looked at other diagonals. I looked at this is a very common trade right here.
What is
this?
This
Is a bull put.
Okay.
This is a really simple trade. There's a lot of people who like naked puts. I'm not a fan of naked puts or cash secured puts, only because you get stuff that happens. I'm going to pull up Dollar General just to show people who do naked puts, hey, there's support, and then you get the stock dropping down to here.
Yeah.
So I'm not a big fan of naked puts. I think, and I could convince most people that they probably shouldn't do cash secured puts. You can make more money, have lower risk, get a better return, higher probabilities using the put spread. It is a little bit more complicated, but let me show you what would happen in here. So I love this what if feature because it helps me to answer the question, what if? Okay. So this is selling a 32 put and buying a 31. Okay. It's a 34% return, $34 on 66. So it's about a 50% return on risk. And the duration is relatively short. Now, I might do more of these depending on, because this $34 isn't a lot of money. So maybe do 10 of them. But you need to have the capital. But for simplicity's sake, let's just keep this on a one contract basis so people can do the math. But what would happen if the stock drops below the 32 and I do get assigned maybe early and I end up buying the stock at 32? So the software allows me to model that. So what would happen is this 32 put essentially expires worthless and I buy the stock for $32.
Okay. You're doing this better than I could do. This is so cool.
Well, check this out. So here's the trade right now. What's the most I can lose on it? $66.
Yeah, $66. Okay, I got
most you can lose on the trade.
Yep, and you have the two check down there. I see that. So you're using
a short put and I have a long put protection at 31. Yep. I get assigned at 32. I buy stock at 32. Now I'm putting $3,200 of capital in the trade.
Yep.
$3,200 of capital, but I can only lose $66 while I have this long put. If I get assigned early, and depending on where things are, and if I get lucky, I might be able to sell a call and be in a risk-free trade. If I get assigned, people freak out about getting assigned early. Listen, dude, if you get assigned early, that's a good thing for you. The pricing would change, but I'm showing here that if I could bring in 121, I could. Here's the situation: I make $55, or I make $255.
Right.
If I can sell that call, you got to have a lot of things that are going to be right for you.
Sure.
But this is what allows you to be cool as a cucumber when everybody around you is losing your heads. You've got this long put in place that could work for you.
So the point of the matter here, just for the folks, is that this is the adjustment phase. You've just adjusted a trade that may have gone a little bit against you, and you're turning it into a potential negative into a very cool positive potential here, right? Just moving things around.
This is not, well, I would add the caveat. We're not in the adjusting phase. We're in the planning phase.
Oh, I got you. Okay.
We're planning our adjustments here.
Got it. Very cool. Go. That's good. That's even better.
Yeah.
And that's great to know. And this is the stuff you guys teach at Option Animal
and we demonstrate at TraderOasis. Yeah. So this is part of this is level 3 at Options Animal. This is the bull put, the credit spreads.
Yeah.
And then we get into the other stuff at higher levels. All right. So what I wanted to show here is just modeling this trade really quick. In the spreadsheet. Okay. I talked about calculating your returns, return on risk, and return on capital.
Yep.
So this particular trade, we're looking at making 34 on $66 of risk. Capital, secondary exit capital would be $32 or $3,200. The return on risk works out to be a 51.5, an annualized return on risk, which is taking into account the duration. So that formula is 365, the number of days in a year divided by the duration. But this other one, when I talk about annualized return on, I'm looking at my capital. So my secondary exit capital, one of the questions we have to ask ourselves is, I'm setting aside capital to do this trade in order to make it a valid secondary exit. Is it worthwhile for me to set aside 3,200? And on that capital, which I may not have to ever use, if I do use it, I'd be making 16% annualized return on that capital. So it is a fair, for me, I actually try to get that number closer to 20. So maybe I would go back and look at tweaking some of the strikes here a little bit to see if we could get it a little bit better. But 16 is not anything. If anybody, you told the portfolio manager, hey, I'm making 16% annualized, that's a pretty damn good return for most people.
Pretty happy, right? Pretty happy, right?
Yes. Yeah.
I like it. Okay, good. I love this. We're going to delve a little bit more into this because I have questions about this on the next episode. Is that cool?
That is cool.
All right. Awesome. Good to see you. We're creating a little book here. This is unreal. A video book. We're going into episode 3 next time. Stay tuned for that. And we will get a little deeper into the trade and some of the other adjustments potentially, right?
Yeah, it'll be fun.
Right. Good. Good to see you as always.
You too, my friend.
Knock it down.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.